here, so I worked for 30 years now for tax, and I was so confused. So finally, I created this chart to basically like have a handle on tax. So I created five contexts for tax content. So the reason people are overwhelmed with tax or anxious because there's so much content. So all this content I summarized from these five contexts. And if you grab these five contexts, it gives you a framework to think and to plan your finance, to plan your story. Let's say it in a simple way. Okay. So the first is intention. Most people think, well, intention of the tax law is to collect tax to run the government. This money is not enough to run the government. The government just issue money. Okay. So the intention of the tax law is to incentivize citizens to take advantage of all the incentives to take care of yourself, your family, your business, your community. So if you use these tax laws, you're a good citizen. And if you just pay tax, you're a lazy citizen. It's like in the Bible, right? 3 stewards, one steward take the money to bury down. It's like if you just pay the IRS, say, hey, go use my money. Well, you're not responsible, right? You want to use the money to take care of your family, your business, your retirement, your future, your community. Okay, that's responsible, and that's why Warren Buffett said, "I pay less tax than my secretary." Probably Bill Gates pay less tax. He didn't say it, but as far as I know, all the money went to, all the money. First of all his money is capital gain, and all the capital gain, all the money, the stock went to the foundation, and there's no capital gain. He has no income. Okay, he traveled all over the world with the foundation's expenses. There's no tax. Okay. Second, there are 3 types of income that will impact your tax. I'll expand a little bit later. And then the structure, you understand the structure. Now, every time I'm talking about something, oh, well, like Donald Trump came to power in 2017, he created this tax law. Now you know what he's talking about. Oh, he's talking about in that section, this QBI, qualified business income deduction. At that section, I have a deduction. I understand it now, and it's good to have my own business as a flow-through entity. Okay, so you understand the structure, and it's very simple. I will show you visually. And the strategies. There are only 3 strategies. If you summarize to the top, there's only 3 strategies. So all the tax strategies, you can summarize to these 3 strategies: deductions, shifting, exemptions. Okay, I'll give you a little bit more examples later on. And then vehicles. So in America, if you want to build wealth, I'm talking about real wealth, okay? You want to invest in real estate, in business, your own business, and the indirect business, invest in stocks, and the tax savings, because these 3 things actually come together. If you don't learn tax savings, you have a silent partner called IRS. He does not do any work, but he occupies 1/3 of your profit sharing. You think about that. Okay, so you must learn that, and I really acknowledge you today to come and learn. It will, if you know this or not, your financial freedom, your life planning, retirement planning, it's like a 10 years, 20 years difference. and then it will impact your children's life. Okay. So if you learn this, and I always say people like myself, we are first generation immigrant, right? From, China, and then we came without any assets. But if you learn this, I guarantee you, you will have assets for your retirement and for your children's education. And by next generation, they stand on your shoulders. Like they have assets. They don't need to, work for money. It's like my daughter is blessed to learn arts. Like, when my generation, I couldn't have that luxury, right? And that's because, I took time to learn these ways to build assets. And then the content. So you put all the content inside these contexts. So whenever you learn some content, a new law passed, oh, this will impact in this section. This is give me this deduction strategy. Okay, like, okay, this renewable energy tax credit. Where does it go? Portion of it goes to the income section deduction. Portion of it, goes to the tax credit, right? So now let's dive into the 3 incomes. The first income is the earned income, and that's the worst income, but sometimes you have to do it. It's worst income because it's double tax. So you need to pay ordinary income tax, plus you need to pay social security tax or self-employment tax. Okay, so that's like your W-2 income or your S corp, your K1, your LLC income that you actively participate, you actively earn through your service. Okay, so that you need to pay double tax. So you think you are paying only 30%. No, you're paying 15% on top of that. So 45% is gone, earned income. Okay, so I have clients come to me, it's like they thought that they are making so much money. It's an LLC, it's a partnership. They're making $1 million. And then like they're paying so much self-employment tax. Okay, and then later on I will show you a strategy to avoid that self-employment tax. Yeah. And then passive income. So passive income, you still have to pay self-employment, still have to pay income tax, but you don't need to pay self-employment tax. So passive income means you do not earn this income by working. So you sit there and the money came. Example, like rental income, right? So that's passive income. So the beauty of passive income is that you don't have to pay self-employment tax. Okay, you pay income tax only. Okay, so that's a good idea. Maybe you can engineer something, right? You can have some, your friend is making good money. You say you invest in something. You don't need to participate, but you earn some money, right? So that's passive income. Okay. Capital gain. So capital gain, you pay income tax only, and even better, you pay a better term, better rate. Even your income is very high, you only pay maximum 20%. Okay, so capital gain is even better. And then capital gain, that's how you build wealth over time. Time is your friend. That's how you build real wealth that you can use for retirement and you can pass on to your children. That's where you make friend with time and you make friend with your capital. Okay, that's why some of the ideas I will share with you, like a private foundation, is so good. This is where you plant a tree and let it grow, and then it will bring fruit generation by generation. That's a long-term thinking. That's long-term thinking. So when you think about that, we have to sometimes when we start, right, we need to earn the income. Now this earned income will give me ability to borrow. Then I borrow and I acquire capital. And that's how the long-term income is. Okay. And then later on, I will share some strategies like when you earn income, you want to pay less tax. So you put it into 401k like that. And then, but when you take it out, you have to pay tax. Now, how you do that? You find ways to convert into Roth IRA. And how you convert into Roth IRA without paying tax? Well, some strategies like, you use charitable strategies. Okay, later on I'll show you some examples. Okay, so that's how you think. Short term, immediately, I'll save every penny I saved is every penny I earned. Long term, how I can grow my assets and pay no tax. At least defer tax. Okay, so that's how you earn money. That's how you create wealth. I'm talking about. So you can use, LLCs, corporations. So corporations by default is a separate entity, and later on you will also think, how you can use shift some income. For example, your S corp income is very high because S corp flows to your personal, and then your personal tax rate is high. Okay, can I do a corporation C corp to shift some income to the C corp by creating a story where, okay, your C corp is providing a service to your S corp, like marketing service, consulting service, management service, IT service, whatever, right? You can create something like that for shifting. And then LLCs are most flexible. You can choose S corp or C corp. And then partnership, by default is a partnership that flows through to your personally. And then pass through entities, right? You can get the 20% QBI, and all of these are, can be pass through entities. In also corporation, if you choose S corp, you can treat it as pass through entities. And even Schedule C, sole proprietor, is pass through entities. Now, most people don't know that, and most accountants, overlook that. So you miss that 20% deduction. Okay, and even like your partnership, your LLC that hold your rental properties could be a pass-through entity. All you need is classify this is active income. Okay, you actively participated in your decision making, in your management. So that goes back to that context, the 3 types of income, right? So, and going back to the story, right? Most of the clients, like some clients, they have a W-2 income and they're making, $200,000 to $600,000, and I can say, hey, you create a Schedule C, just call consulting, and then you can write off your car, your travel, your supplies. If you are making $600,000, you write off $60,000. Still, the story makes sense, right? So that's how you look at the bigger picture. Like even if you are accurate, I had a case where a client get audited, and then they bring the information to my mentor, and he took a look, and it's like, oh, okay, no wonder you get audited. Yeah, but everything is accurate. I support when they audited. Yeah, but still the story makes no sense. And when they audit you, they will fight with you, and you need to at least pay them enough to worth the time, There's no way you have every backup, right? Of course, you'll find something. So, and think about the time that wasted. So he looked at this, okay, show me how much expense you had in QuickBooks. And he reallocated to different line items. And then the IRS auditor said, this year makes sense. So always come back to the story, right?